there. Very good to see you. I have an age-old question. Today we're going to talk through fee-only versus fee-based, which is better for your financial plan. So we're going to talk through that difference between fee-only planning fees and fees that are deducted directly from your accounts and how those fees can affect your retirement savings. But let's start by clarifying what we mean by fee-only versus fee-based.
Well, it's really about the nature of the relationship. And there's actually three different compensation models: fee only, fee based, or commission based. Fee only is that I am charged with putting together a plan or making recommendations, but then handing them to the client for them to implement, execute, and monitor on their own. And I hear a lot of people saying, well, that's what I want because I can rest assured that it's in my best interest. And I would agree that it should be on the day that you receive those plans and recommendations. But the world changes, your life changes. And so more often than not, I find that people would like to fall into kind of the second category of relationship where there is an ongoing relationship and it is really up to the advisor right there along with you, kind of holding hand to provide ongoing proactive management, implementation, and execution. And that's generally fee based on the amount that is being managed. That is the compensation to the advisor rather than just a flat fee for handing you the recommendations. And then the third, commission based, that is generally more of a assistance in shopping and then purchasing a product. And the most common example would maybe be life insurance. There are insurance agents that can go out and shop the insurance companies. But I have also seen where mutual funds have kind of an upfront commission when they are purchased, and then maybe or maybe not have some ongoing fees as well. And I liken that to kind of a double dipping of sorts. But it depends on the needs that you have and the relationship that you desire with an agent or advisor or planner. And I find that more often than not, maybe there's not complete understanding or disclosure of the distinctions and then where that relationship and therefore the investor's costs are derived and the advisor's compensation is generated.
So fee-only advisors can't receive any other compensation, which allows them to act as fiduciaries. We hear that word a lot. What does it mean?
We do. It's become more and more of a buzzword in the financial world, and fee-based advisors may be held to the same fiduciary standards, meaning that they are charged morally, legally, and ethically for looking out for your best interest whenever they are making recommendations or executing the management of the account. And more importantly, they are held to that standard as they are putting the plans together and then executing on them. And so again, the day the plan is handed to you under a fee-only arrangement, those recommendations should be in your best interest. That's what the advisor is being compensated for. That's what you're writing the check for. But with a fee-based relationship, there should and could, and most of the time is, the same requirement for that responsibility, where there is an ongoing responsibility to the client, the investor's best interest, as the advisor continues to manage the account on an ongoing basis. And then the commission based, that is outside of that fiduciary responsibility per the purview of regulating bodies and the DOL and FINRA and the SEC all kind of say, well, a commission-based sale could potentially create a conflict of interest, but there are often times where a properly placed life insurance policy is absolutely, I think, the best thing for the financial stability of a client or the client's family under the worst case scenario. So any of them can be absolutely in your best interest. It's just that I think there needs to be more clarity on where the relationship and therefore the compensation falls and how that compensation is generated. And a lot of times the water is very muddied there. And I think that is part and parcel of the very nature of that fiduciary responsibility.
So why does the distinction between these two fee structures matter for the investor?
Well, I mean, your costs matter. Your costs are going to be an element of your total returns and your progress. So it's out of pocket money versus money that's coming from the account. It can actually factor in some cases to taxation. I'd like to dig a little bit into that, but you should know your total cost, not just one layer of an onion, and you should understand the benefits that you are going to receive from any costs that you are paying.
Right. So you said you wanted to get into specifics. Let's do it. Let's break down that math. Let's say that I am working with an advisor who is charging me a $1,000 fee.
Yep. And let's just say that that fee is on one hand fee only, or on the other hand fee based. Maybe it's a 1% fee of assets under management, which means that's about $100,000 account balance to start with, right? Well, under the fee only arrangement, you're writing a check. You're writing a check out of your cash. Under the fee based arrangement, it's coming out of the account itself. So let's say that this is an IRA, a tax deferred account. Well, on the fee only side, you're writing that check. You would have already had to have paid taxes on it, which means if you're in a 25% tax bracket or tax rate, you actually had to earn $1,333, pay the taxes on it, and then write the $1,000 check. Whereas under the fee base side, that is deducted directly from the account as you go. It's coming out from a pre-tax tax deferred account. You only had to earn the $1,000. And generally the fee-based advisor, that 1% fee, the $1,000 on this hypothetical $100,000 account, that is prorated over the course of the year. So if you don't feel like you're getting the service that you deserve or the benefit that you should receive, you can terminate that relationship and end that cost. Whereas the fee only stroke a check and get the recommendations, that check is done and out of your account kind of on day one. So there are benefits and disadvantages to every option here. It's just that I think that people need to weigh those benefits, disadvantages, and the cost with this decision very carefully to see what they're comfortable with, because maybe they are very comfortable self-managing their accounts and just want to double check to make sure they're not missing anything. And the cost for that should not be too exorbitant. But I have seen where people are paying $10,000, $15,000, $20,000 for a fee-only plan that really isn't providing them much more guidance than what they're currently doing.
Right.
And then I've seen on the other hand where they could pay significantly less or equivalent for somebody that is held accountable step by step along the way for ultimately your success and your forward financial progress, and to spot and identify the same blind spots or red flags that you may not have otherwise known about on either side of the equation.
Mm-hmm. So I want to ask you one follow-up question with that. If I am working with a fee-based advisor and that fee is coming out of my retirement account, isn't that limiting my potential for future growth?
Right. Those dollars would be removed from the account. Yes, valid, true. But on the other hand, right, we're comparing the two and there's still a cost on the other side. So you still would have had to write the check. So the cost there and the removal of dollars is going to be the same on either side. There is going to either be a cost to write the check to get the fee only advisor compensation taken care of, or there's going to be a deduction of dollars from the account on the fee-based side. And those dollars, yes, are removed and don't make the same return, but the cost is the cost either way. And this is also kind of a loose segue here. One of the reasons in taxable accounts like brokerage accounts, after tax accounts versus qualified retirement accounts like IRAs or Roths, where there is a difference and distinction between mutual funds and ETFs and how those are taxed as well. So again, you've just got to know your total potential costs or expenses and be proactive, and then weigh what is that cost, what is the all-in, what is the potential liability, and then what is the benefit for paying that cost. And either way, you want an advisor that is aligned with your best interest. You want to make progress. You want your account to grow. The advisor should have the same incentive.
Right. And that is my next question, Peter. If you are working with an advisor who is charging you a percentage of the managed money, he or she absolutely has a vested interest in your success.
Yeah, you want your account value to grow over time. The advisor also wants your account value to grow over time. That is the way the financial world views aligning the interests so that there is not the potential conflict of interest. And so on either side of that equation, on the other side, there is not that alignment of self-interest and advisor interest, or self-interest and client interest, whatever the case is. If those interests are aligned, that's the way that the financial world truly justifies and measures that fiduciary responsibility having being made and met. And I hear commercials out there that try to create this false sense of distinction. At our firm, we only make more money if you make more money, while at other firms, they get paid whether your account does good or bad. That's actually describing the exact same thing. There is no line of distinction there, although they attempt to create it in those commercials. And I wonder why, there is that sense that they are trying to create that false sense of a distinction between the two. I often wonder about that. But, as long as you are understanding what you're paying and getting the benefit that you are paying for, any of these models could absolutely be appropriate. It is just, do you know what you are paying, what the relationship, what the compensation model is with that advisor, and are you receiving? How do you quantify and measure the benefits that you are receiving for that cost?
Right. And Peter, I know that you are very transparent in your fees, and that you offer these complimentary consultations. So if somebody would like to just get the ball rolling and have this conversation with you, how can they reach you?
We are and strive to be very straightforward with all costs and not just one layer of the onion, kind of talking about all of the different layers of the onion there, and any and all expenses with your money. And the first conversation and an analysis of the cost that you're paying is always complimentary, no cost, no obligation. So if you would like a better understanding of the costs that are involved with the management of your money, or would like to look at other alternatives, please feel free to give us a call, 919-300-5886, 919-300-5886, or you can visit online. It looks like richonplanning.com. It's my last name, Peter Richon, richonplanning.com. You can email me, peter@richonplanning.com. But understanding your cost, Erin, very, very important, and what the expectations are that you will benefit from having paid those costs.
Absolutely. Peter, thanks for your time today.
Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. One of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k, or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings, and see what your tax bill is likely to be if you default and defer to the IRS's plan, versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.